Thank you for watching this video. We would like to thank our 2024 gold level sponsors, Geronimo Properties, May Property Management, Northmark, Boston Planning and Development Agency, and Cabot & Company. We would also like to recognize our 2024 charitable partner, Ironstone Farm. The views expressed on this program are solely those of the participants and do not reflect the views of the CCIM Institute, the New England CCIM Chapter, or any other organizations. Greetings and welcome to episode 3 of the New England CCIM Chapter Podcast. I'm Michael Chase. I'm a former chapter president from 2022 and a current chapter board member and treasurer. I'm also a commercial mortgage banker with Northmark, helping my clients with debt and equity solutions for their investment real estate. As always, I'm joined by my co-host, Matt Mayrand.
Hey, thanks, Mike. I'm also a board member at CCIM. I'm the owner of May Property Management and the vice president with Glickman, Cavago, and Jacobs. I've been involved with commercial real estate for about 20 years now.
Before we dive into today's topics, we'd like to mention a few items. Last week, the New England CCIM chapter had 5 people complete their path to the pin and become CCIM designees. We would like to congratulate Joe Robinson, Katie Medeiros, Jennifer Small, Anthony Dolan, and Patrick Crawley. The New England CCIM chapter was also recognized with the 2023 Chapter of Excellence Award for Designation Promotion. So thank you for everyone's hard work who helped to make that happen. We also have a few reminders for some upcoming events and education. The chapter is hosting a 102 course from May 13th to May 16th in Medford. The 102 course covers market analysis for commercial real estate. You do not need to have taken 101 before this course, so it can be a great way to kick off your path to a CCIM designation. The chapter is also hosting a pickleball open on Thursday evening, May 23rd at Pickle Boston from 5:30 to 8 p.m. And then finally, please keep an eye out for information on our annual summer social. We will once again be hosting it at Intercontinental Boston, and it will be on the evening of June 23rd. Matt, any reminders on your end?
Yes, big one. You talked about promotion earlier. Let's talk about sponsorship opportunities. You know, any company, any business, either nationally or regionally, that is interested in communicating with trained and educated real estate professionals, we have a slew of sponsorship opportunities.
Great reminder. And these are just a few of the programs, educational and sponsorship opportunities that the chapter has in the works. Please check out the New England CCIM chapter's website. Follow the chapter on LinkedIn to keep up to date on all opportunities and events. So, Matt, let's jump into today's topic. We wanted to talk about how we're seeing people get things done in a challenging market, particularly on the financing side. I'll throw it to you as someone who helps your clients, as part of the transactions that you put together, you're seeing them potentially struggle on the financing side. What are some tips and tricks that you're seeing that can help them get their transactions done?
Yeah, Mike, it's a great topic. And of course, there's so much going on that it is a challenge. We've heard about so many deals that started out with a pro forma based on, 3 or 4% interest rate. Now they're finding rates all over the place, quite frankly. I've seen rates as high as 8.5. That 8% is a very, very big number for a lot of deals. So yeah, it's critical to get best deal that you can find, the most favorable terms. Terms are, in my opinion, in many cases, almost as important as rate. Of course, you got to get this thing, whatever project, whatever thing you're doing to the finish line. Now, Mike, obviously you do a lot more of this than I do. I know a lot of it from kind of the boots on the ground, helping my clients, but you're kind of the man behind the screen, sort of, the great Wizard of Oz. You get to see some of the inner workings of this stuff. What kind of stuff do you see with the various banks and private and public financial institutions that you work with?
There are a couple of things that we're seeing that are helping to get deals done today. On the seller side, one way we're seeing some of the more aggressive priced transactions still taking place in the market are made possible because of assumable debt that's in place.
Yeah.
It's an opportunity for a buyer to be able to take over a legacy loan, still has that interest rate that starts with a 3, and in turn that seller is able to maximize the sale price. Bring that forward to today, and how can sellers use some tips today in order to set themselves up for that type of scenario in the future? And one of the things that we're seeing coming back into the commercial space that's kind of always been there, but really hasn't been as prevalent, and certainly not as prevalent as you would see in the residential space, and that's points. And we saw last year, Fannie and Freddie were the first to reintroduce points into the commercial space. The ability to pay a point, buy down a rate, and make your loan more attractive for that potential buyer down the line who might be looking to assume it. Also, by paying points on many of these loans because of the higher interest rates and what have you. They're what we refer to as cash flow or debt service coverage constrained. That's the limiting factor in their loan amount, not necessarily the loan to value. So by paying points and dropping the rate, you're creating extra room on your debt service coverage ratio or an extra cash flow. It means you can get more loan and
Really? That's
additional
powerful.
proceeds. That is one thing that we're seeing. And then the biggest tip that, of course, we're seeing out there, and this goes more broadly, not just for the agency lenders or institutional lenders. And I think you probably are seeing this as well with your clients. And that's how can we make our transaction more than just a real estate transaction? What can we
Right.
do to entice a lender in other ways? For some examples of that, it could be, is my project, does it have an affordability component? Does it have a green component? Does it have a social impact? Can I appeal to a local bank for their CRA credits? Can I appeal to an institutional investor who's looking for ESG credits? Those types of, and of course, going back to Fannie and Freddie, can I get in and take advantage of some of their green reward or mission-driven programs, which offer significant price breaks and, again, additional proceeds in hand with those? What are some ways, Matt, that you're seeing some of your clients set their deals up so that it's more than just a real estate transaction?
Yeah, you brought up a couple that just, kind of made me think. The one that we see quite a bit I deal mostly with, community banks, local regional banks. And, one of the tools that they love to see is SBA financing. So SBA has a program, SBA 504 loan, where if you are a user, right? So you have to use 51% of the property for your own business. But if you're a user and you're going to own 51% of it yourself, the SBA will basically come in as a guarantor for a portion of the equity component. So the way it works is, the SBA takes a piece of the guarantee, and the bank doesn't have to guarantee quite as much. So the bank has a very, very low risk to default on this, because they know, even in the worst case scenario, that the SBA will kind of step in and make everything right. So lenders love that. But again, 51%, there's some caveats. Also, there's, reporting requirements. I have an SBA line of credit, and, the line of credit's at 10% now, right? Which is kind of a good deal, I guess. It's a decent, decent rate based on the current spread, but 10% ain't 3%, right?
Right.
So, those are a couple programs. And then, you mentioned on multifamily front, here in Worcester, we've seen a lot of projects that, went in for approval a year ago, prior to Worcester putting in a requirement for low-income housing. So 12% of all new developments now have to include an affordable component. Everybody rushed to get all their paperwork in prior to that being kind of grandfathered. And so a lot of those deals are starting to be built now, and many of them have an affordable component. So low income tax credits, certainly the bigger developers, many of those historic tax credits. So those kind of public-private bridge type components to the financing is very, very common in the history of Worcester, because Worcester has always had a bit of an issue. Construction costs in Worcester aren't dramatically different than Boston, but rental rates are, right? So there's always been a little bit of a delta whenever you're trying to build in Worcester, because it's just not the same, revenue. So we're kind of used to that, but we're coming back to that same kind of idea, that same situation. Is like, well, it doesn't work just straightforward. So we need a kind of a public-private partner, or an SBA loan, or some other kind of bridge in there to help, the whole finance stack kind of come together.
It's great that you're talking about the capital stack, because certainly we're looking now to help our clients fill those gaps in the capital stack. And
Right.
You mentioned a couple of points in there talking about, tax credits, historic tax credits, low-income housing tax credits, and it brings up some interesting opportunities for people to be able to stack programs, right?
Right.
If you're looking at saying, let's say you have to meet some requirements for sustainability or energy efficiency. You might be able to get some tax credits through, 45L or 179D. Then you might be able to get yourself set up for a green rewards program from Fannie or Freddie if it's a multifamily program. So then you get the attractive financing on top of those tax credits. And then many of those improvements that you're probably going to be installing in order to achieve those energy efficiencies probably qualify for cost segregation and hyper depreciation. So now you're getting tax credits, you're getting depreciation, hyper depreciation through cost seg, and you're getting attractive financing. And that can help bring that deal together just by stacking all of those potential programs.
Right.
One of the other things you mentioned was, SBA. SBA, of course, is incredibly powerful for owner occupants,
Yeah.
being able to maximize financing and leverage up to 90%. It really is can be a home run for some of those borrowers. One of the interesting things that I like to do is I actually like to work the SBA process a little bit backwards.
It's a good
And
idea.
what I mean by that is the most common path to an SBA loan is a sponsor walking into their bank and saying, "Hi, I'm interested in financing." And the bank saying, "Great, we're going to give you to one of our CNI loan office, business development loan officers." And then they'll talk to them about SBA financing. So you're talking to one bank who's then going out to the SBA to generate the loan. What many sponsors don't realize is the bank is not necessarily talking directly to the SBA. They're actually having to work through a number of organizations who underwrite on behalf of the SBA, and they're called CDCs. And
Right.
there are, half a dozen or so around the region here. What I like to do is I tell my clients, talk to the SBA originator, that CDC group first. Get them to buy off on the SBA, the debenture portion of it. And then once they've signed off and said, yes, this qualifies for SBA financing, we're on board, we're willing to write it. Then you go to them and say, great, which is the best bank that's going to give me certainty of execution? Who's the best loan officer to work with at that bank? And they will tell you, yes, you should work with this loan officer at this bank. They will get it done for you. And now you've worked it backwards.
That's
Again,
completely true. Yeah, I know, locally, I know a few people, and it just so happens that like my lender that I work with, she's like an SBA expert. But I can also tell you that, of the many, many other bankers that I know, not it, very few of them have the same level of expertise that she has. So, if you talk to any, a dozen of these guys, there's one or two of 12
right.
that might have that. So I love that idea. And it also goes to SBA makes your loan very desirable, right? So if you're going in there and you're making, that SBA connection, that this is something that will work for your project. Now you can shop your deal a bit, and you have something desirable. So now you're, as a developer, as a buyer, you're no longer working from like this unknown thing, please, Mr. Banker, give me a loan, right? No, you've got something that they want. I can tell you personally that having a good connection with your lending officer or the folks at the SBA. So if there are some problems, you can, have a conversation with them about it. And I've sold some properties that were foreclosed on by the SBA. We haven't seen that in a while, but it happens, right? And you want to make sure that you work that through the best that you can, because it's a federal loan.
Yeah.
The government doesn't forget. You want to do your best to work that thing out, and everybody will help you as long as you have a good, partner. And I'm a big believer in, relationships, and I know you are too. Having a relationship with many lenders, many financing sources is kind of critical to being in this business. Just like you need a good accountant, you need a good lawyer,
Yeah.
you need some good engineers. You really want to have a good banking relationship.
Absolutely. That's critical. And when you are that owner occupied business client, you of course have other lines that are attractive, other business lines that are attractive to a lender that you can be offering to them. But if you're not an operator, owner, user, and you're not necessarily going in for SBA financing, you're just an investor, a developer, one of the ways that you can kind of help move the needle is being ready and willing to bring deposits and expand that banking relationship beyond just the real estate loan. Because right now, many banks, they're struggling with managing their balance sheet. They've had deposit flight. And, what's interesting is their regulators, they for every commercial loan they do, they have to set aside a little bit of risk-based capital. And that happens to be about 8% of the loan amount. So if you can bring that 8 to 10% of your loan amount and just park it at the bank in the form of deposits, you've basically funded their risk-based capital reserve requirement for them. And that can certainly help move the needle in today's market.
It's interesting. Yeah. So I just closed on a loan for a client, a condo client. They have a lot of capital improvement projects that they're working on. And so I've done a number of these over the years. And recently, the banks are really, really interested in these deposits, as you mentioned. I never knew the percentages. I know that they want the deposits.
Right.
And I know other banks, and I've talked to, some national banks as well. They're all interested in these deposits because it allows them to lend more, right? So
Absolutely.
whatever amount they bring in savings, they can divide that number by 8 or 10%, and that's how much they can lend based on that deposit, right? So that's a pretty powerful leverage.
Absolutely. So, 2 years ago, they might have asked you for the operating account for the property and you might have balked, and they would say, okay, yeah, that's all right.
Right.
But now it's much more of a firm requirement. That kind of gives you that behind the curtain look is, well, why am I seeing all of a sudden these requests for deposits in these term sheets when I hadn't seen them before? And so anything else that we can provide our listeners today is, how can they get their deals done? How can they help move the needle?
Yeah. The only other thing that I could think of is, as we talked about, building those relationships are really important. Making sure you have your ducks in a row, right? I mean, this is like, be prepared. When the banker says, hey, I need a personal financial statement, I need tax returns, don't say, huh? Get them what they need. Have a nice little packet put together, explaining what you were going to use the money for. If it's a investment, put together a pro forma, show them what it's going to look like, show them how fast they're going to get paid back. And, banks, they're risk averse. Make it as easy as you can for them to say yes. And I think just generally speaking, you're going to have much better success. And, certainly that sounds obvious, but I find that it's not, certain big professional folks, but if you're running a good sized business and you don't do this all the time, you've got a million other things going on, you might not have it all together. And it really is critical.
Be prepared and have a good team around you. Sounds like this is a live
like
by.
A Boy Scout or something.
That wraps up today's podcast. Thank you again for listening. Please feel free to follow us, like and subscribe to this video below. Follow us on LinkedIn and other social media platforms. And thank you for joining us.